Hi, and welcome to this video. My name is Jerry Peterson with Tampa Real Estate Solutions, and we're here to talk about your home. I'm reasonably certain that when you purchased your home, if you've come to this video, it was your dream home, and you were ecstatic, and everything was wonderful. And then we had a market downturn, and you find out later that your house is now worth less than what you owe on it. So, your house begins to feel like a boat anchor, and it's dragging you down, and it's leaving you in a situation where you don't feel like you've got any options. In fact, you feel like a drowning man, or a drowning woman, I'm sorry. And you're wondering, what are my options? How can I get out from under this? And time passes, and eventually you find out that yes, in fact, your house is underwater. Now, another way of saying underwater is that, again, you owe more on your house than it's actually worth. So the challenge is, how do you sell a house that's underwater? Or another term for that is over-leveraged. There really aren't too many options available to you, so let's look at them. So how do I sell an underwater house or an over-leveraged house? Well, the first option is I can go ahead and sell them the traditional way, and I just have to come up with the difference. And my guess is, if you actually had the money to do this, you wouldn't need to sell in the first place because you wouldn't be in any kind of trouble. You could just keep paying on the house and you'd be in good shape. The second option is you can ask the bank to take what's called a short sale. And what that means is the bank accepts less than what is owed. A third option is that you can walk away and let the house go into foreclosure. But of course, there are some negative credit consequences for doing something like that. And I hope that the reason why that you're watching this video is that there may be another option. So I'm going to hold off on unleashing or unveiling what that option is for a little bit, but let's examine some of the ones that we talked about. All right, so we can do a short sale. So you can ask the bank to accept what's less on the home than what is owed on the home. However, you kind of lose control at that point because since the bank's agreeing that they might take a discount, you're giving control to the bank. They have to approve any sale. And since the bank is taking less than what you owe them, it seems rather unlikely that they're going to allow you to get any money out of this transaction. So you probably put money into your house when you bought it, put a down payment in, put improvements in, whatever. But you're going to walk away with nothing. In fact, it's even worse than nothing because when you sell, you're going to get what's called a deficiency judgment. And along with that, at the end of the tax year comes a 1099. And then that gets sent to the IRS, and the IRS will consider your deficiency judgment to be income. And I kind of looked at that and said, well, so much for the discount because I have to pay tax on that money as if I had received it. So there's a few downsides to a short sale. We talked about the option of walking away. Well, if I walk away, that basically means my house is going to go into foreclosure and the bank's going to take it, and it's going to be on my credit for up to 10 years. And the bank may decide to get a judgment against you based on the promissory note that you signed. So even though they took your house, they can still come after you for the money that you agree to pay them. Now, I'm going to say that not many banks do that, but it's certainly not unheard of, and it's something that you should be aware of. The net of this is you can basically forget about getting another mortgage anytime soon. And if you're out of your 20s, welcome back to being a renter. That's not where I wanted to be. All right, so we talked about another option, and in fact there is one. It's called a negotiated settlement. Let's do a comparison of what I think are the two best options that we've discussed so far. The short sale and what we know as the negotiated settlement. And again, for a short sale, the bank must approve any offers. Now, I don't know if you remember this, but when we did the bailout of the banks 10 or so years ago, maybe only 8, they changed the rules a little bit about how banks can deal with real estate. And you might have noticed if you've tried to do a short sale that the banks are less willing and less motivated to work with you. And that's because they've been allowed to put insurance on their mortgage. So it may actually be better for the bank financially to foreclose on the house than it would be to accept a discount. So, again, you're subject to them and they have to approve any offers. And if it's in their best interest to not approve the offer, you may go around in cycles for a long time before it actually gets done. And that's why the bank may choose to let it go into foreclosure. Again, we talked about you're going to get a deficiency judgment, a 1099 for this, and the IRS is going to expect you to pay tax on the deficiency judgment. I repeat, if you had that money, you probably wouldn't be in any kind of trouble and need to get rid of the house. And of course, it's going to affect your credit because all the time that you've been not paying is going to be reflected in your credit statement. In a negotiated settlement, the seller's in control. You decide, you as the seller decide if an offer will be accepted. The bank agrees that the loan will be considered paid in full, therefore there's no deficiency judgment. In the negotiated settlement scenario, the seller's credit is not impacted, and in some cases, the seller may actually participate in the proceeds of the sale. So that means you might, even though this house had to be sold for less than you borrowed on it, you may be able to walk away with some amount of money. Now, I can't promise you that you would be able to do that, but it is possible. At the bare minimum, you're not going to walk away with a deficiency judgment and get a bill from the IRS saying, hey, you got a bunch of money here. All right, so what about negotiated settlements? How do I find out more about them and whether it's a good solution for me? The questions you should be asking is, does my house qualify? And what is required to get started? How does the process work? How soon do I have to move? And this only applies if you're still living in the property. How can I make money from the sale? And what do I have to do to sell the house? And finally, when can I get started? Because honestly, the quicker you get started doing this, the better it's going to work for all parties. And that's actually what I want. I would love to give you a presentation on this, but there's a lot of questions that have to be asked both ways on this. So I think the easiest solution is just to have you call Tampa Real Estate Solutions, and we can answer all of your questions. We can find out if it's going to work for you, if your house qualifies, and it isn't qualifying with us so much as qualifying. It means there has to be a reason that the bank would accept a negotiated settlement. Anyway, what I would like you to do is call Tampa Real Estate Solutions at 813-586-0479, and we will begin the conversation and start finding your way out from underneath your boat anchor and getting out from that underwater house. I thank you for your time, and I hope we get to speak with you soon and find a solution for you. Thank you so much.